Hi, everybody. We're going to give folks just another minute or so to start to continue coming in. So we're going to stay silent just for 60 seconds or so, and then we'll come on and we'll get started. But we just want to give people a chance to get into the room. Okay, looks like we've got a good group this morning. So hi, everybody. We're going to get started. I'm Jason Kleiman. I lead business development and investor relations for Goodegg Investments. Along with me is my partner on the investor relations team, Max McGurk. Hopefully, everybody on this call today, you've probably seen or heard us, or maybe you've even talked to us directly. So it's a pleasure to see everybody online with us. So today, it's yet another iteration of Goodegg Live. This is our chance, for those of you that have been part of this, this is our chance to really talk to everybody directly, based on topics that are on everybody's mind. So we try to pick topics that are sent to us on a daily, weekly basis and say, what are people really worried about? What do we want this discussion to be around? So we try to make these timely and impactful based on what's happening out in the market. So today we're going to talk about interest rates and financing, everybody's favorite. Last time we talked about K1s and taxes, so hopefully we got a lot of positive response out of that. So that was well received. Today we should have a fun back and forth. Before we get into this, I'm going to turn it over to Max. Max is going to give a little bit of background on the company, just to make sure everybody knows where we came from, where we are. And then there's a slight bit of legal stuff that we've got to put out there, and then we'll jump in. So Max, it's all you.
Awesome, man. Well, Jason, I'm excited to be here, as I always am when it comes to Goodegg Live. And then I really enjoy talking about financing, right? I mean, that's the meat and potatoes on how deals are put together. So, well, just a little bit about myself. I'm investor relations. I work underneath Jason Kleiman, and we are the tag team duo for Goodegg Investments. Every one of us, Jason and I talk to every new investor and current investors that are out there. So let's see. Just a little bit about Goodegg Investments, our track record of success. We have been in business for a little more than 5 years. Annie Dickerson and Julie Lamb are our owners, and they got started in early 2018. And in that time, we've had a little over 40 syndications, totaling more than 8,000 multifamily units. We have been able to distribute a little more than $25 million off of the 20 exits that we've had. So 40 different syndications. 20 of those went from purchase to operation to sell. An average equity multiple of about 2.83x, with an average IRR over 20%. So that's our track record. We're in the middle of a raise right now for Goodegg Wealth Fund 2, and we've got many more coming. Before we get started, please note everything we talk about today is for educational purposes only. We are not legal, financial, or tax advisory firm. We recommend that you consult with a legal, financial, or tax professional for all your legal, financial, and tax-related questions. So, are we ready to get talking about financing?
Yeah, from there, let's get started. So let me set the stage first. We've been trying over the past few months to make this as interactive as possible, even within Zoom land here. So what I would invite everybody to do is get into the chat, and if you're so inclined, put in your name and your email address just to make sure we know exactly who we're talking with, and put questions early and often. So between us, we are trying to keep on top of that, and we'll try to answer them as we're discussing. We don't necessarily need to wait until the very end. We used to do it that way, and we're trying to get everybody engaged as we're talking, and make this as much of a true discussion as possible. So please put in any questions in real time, and we'll try to get to them as we're going. So from there, let's jump in. Today, we wanted to make this about interest rates and financing. It's a difficult environment out there for a lot of investment groups, and we don't want to paint a negative picture, but we do want to talk about reality. We want to talk about where things are, and what some people are dealing with, and consequences, and how we're looking at it going forward, and how we're putting ourselves in the best possible position, not only for us, but for our investors, and what we're looking at doing in the future. So The very first question, what does the current market look like? This question could take us in so many different directions. And so I'll start it off. I'll give kind of a little bit of a viewpoint, but Max, I want you to jump in right after this. So we often get asked, what does it look like out in the market now? How can you possibly buy anything? What's happening with valuations? Is now a good time to be investing? What do we do? How do we take advantage of what's out there? Or should we just kind of sit back and sit in our living rooms and watch Netflix for the next year and wait for things to happen? So it's a mixed bag. The reality right now, and we've talked about this for months, is that interest rates have gone up. Obviously, interest rates have gone up, which has been incredibly impactful to deals that are currently in place and also future acquisitions. It makes everything a little bit more complicated. So if we look at it from the viewpoint of what we can possibly buy and how we're going to buy things, well, interest rates are impacting valuations. Interest rates are impacting what the top end number on a sales price can possibly be, because then it impacts the financing that we can actually get. The lenders now are much more critical. The stipulations on what they're willing to lend based on yield rates, based on DSCRs, based on all the little metrics within each individual deal, they've gotten more conservative. It's not just the buyers, it's the lenders. The lenders are driving a lot of this activity. So what happens as interest rates go up? I don't want to give a macroeconomics discussion here, but as interest rates go up, it affects every piece of a deal. So no longer can you get 70% financing. Now, all of a sudden, because of yield expectations from the lenders, maybe you can only get 55 or 60% financing, which forces people to do one of two things. You can either put in more equity, which isn't always possible, or you can go after institutional sources to backfill some of that equity need where you weren't able to get debt financing. Either way around it, it makes the deal more expensive, which makes it so that the potential buyers have to really take a hard look at what kind of returns can you get, what kind of cash flow can you get. And in most situations, what we're finding is that drives down the overall valuation. Now, the selling groups don't like that. They don't like to hear that, my gosh, I've got this project that should be worth $50 million, but based on all of the financing pieces, all of the investor pieces, all the equity pieces, it's really only worth 45 million. They don't want to hear that. There are a lot of selling groups that are still under this idea that if I just put out this quality asset, I'm going to have 20 takers and they're all going to bid up the price. The reality today is that doesn't work. If the deal doesn't pencil out, and everybody on this call probably heard me say this, if the deal doesn't pencil out, you cannot buy it. You cannot stretch. You cannot put yourself out there to say, my goodness, if I just buy this wonderful Class A asset in this amazing submarket, the tenants are going to come screaming and our rents are going to go through the roof and we're going to make so much money.
Yep.
It doesn't work that way. Those metrics may be there, but if you're not buying correctly in this kind of a market, you lose. So it's critically important that we do things correctly.
Absolutely. No, I'll chime in on that one. So a couple of things you said that kind of resonated with me. You talked about 70%, maybe 75% LTV, loan to value on financing, and now that's coming down to 55, 60, 65%. So essentially the bankers want you to have a little bit more skin in the game. They want you to have more equity, right? No different than if you buy a personal residence, you might get in for 3 to 5% down. But if you're buying a commercial property, they want you to have more skin in the game just because they don't want to be stuck with that asset, right?
Yep.
And so the benefit is, does it sound scary that you're going to have to put up 45% of equity? Sure. But the other side of it is you're better into that property. You have, less loan to value. So anyway, that's one thing. The other side of it is, I hope that by saying that valuations and stuff like that are going down, that's not doom and gloom. How I look at that, Jason, I look at it as opportunity. We're in cycles, right? Real estate is all about cycles. We just are getting on the back end of a really, really hot cycle for the past 5 to 7 years. But the best time to buy real estate is always now, right? Yeah. It's not 5 years from now or 10 years from now. So with that, we're going to get into some more details, but there's some massive opportunity on the horizon for us.
There absolutely are. I mean, it's the whole buy low, sell high, right? I mean, right now it's not, if you've got to sell, if there's a reason why you need to sell, or maybe you've been in a property for the last decade and you've capitalized on it, maybe it's a good time to sell. If you've got some financial constraints that you have to sell, well, that's just what you're facing. But those that are in a good position financially from a capital side, if you can take advantage of where the cycle is right now, you're absolutely right. It's an amazing time to buy. But we have to be careful, because there are a lot of folks that are looking at this the exact same way that we are, and they're saying, okay, now's the time to pounce. Well, yes, it may be, and maybe this is going to be even more so over the next 6, 9, 12 months, but you still have to be ultra careful. You know, with the financing organizations not being willing to put out as much money, it requires that you put up more cash, which then, if you're going to put together all these financial models, and everybody's talked to me at length about financial models and underwriting, right? There's this magical equation. There's got to be a certain amount of financing versus a certain amount of equity, and everybody's got certain return expectations on the physical cash that they put in. Well, the more cash that you put in, the lower the overall return becomes. So, but if you put too much financing on, well, that hurts the returns for all the equity players as well. So there's a magical equation there that we have to get to. We haven't found that perfect balance, but that's why we spend so much time going through the underwriting for each individual deal. It's not just if it's 25%, then you're golden. No, each deal is different, and there's a lot of moving pieces.
Awesome.
So, okay, I'll get off my soapbox on that one for a minute. So that's the reality of what we're dealing with out there. Interest rates are still going up. In some markets, they're really fluctuating. The lenders are looking at it's a market by market thing. A loan in Phoenix may be completely different than a loan in Des Moines, which may be completely different than a loan in Jacksonville, Florida, which is completely different from Atlanta, Georgia. So just because somebody says, well, I can get a 6% interest rate, doesn't mean that that's available everywhere. We're seeing interest rates right now in multifamily and hotels and alternative assets that are anywhere from 5.5%, these are fixed, 5.5% to 9%. Well, obviously the 9% fixed rate is difficult. 5.5%, there's a lot of asterisks to that. That's not given out just to everybody. So it's a wide scale. All right, well, let's go to the next one. This will give a little bit more clarity. All right, so what are we looking for? This is specific to Goodegg. Now, each investment group out there in the market, they've all got their parameters. They've got their strategies all put together, and they say, this is who we are. This is what we're looking for. This is how we're going to make returns. Specific for Goodegg Investments, let's dig into that. If we're going to look at multifamily assets, typically what we look for these days is on any individual asset, we don't want to put more than $10 million into it. That's on the equity side. So if that means that there's going to be a $90 million acquisition out there, and if the lenders are asking for or willing to give no more than 60, 65, maybe 70% loan to value, we're going to be hard pressed to make that deal happen if we want to limit ourselves to 10 million. I mean, that limits us to a certain type of deal, certain deal size, but that's where we feel really comfortable. That's it. And we've done many deals that we're writing a check for more than $10 million on an individual asset. But going forward, our strategy has been 10 million and under. That's kind of our sweet spot. We feel really comfortable with that, and we can manage that. What we're looking for on cash returns, everybody wants to see on multifamily, they want us to get to 5 to 7%. Now, that has nothing to do with capital returns. Okay, that's purely the cash flow that we're able to generate off of good performing assets. So to get a 5 to 7% cash on cash, and that's usually an average number. It may not happen in the first year. We've got to find great assets. We have to buy correctly. We've got to have the appropriate amount of debt, and they have to be in markets that truly show growth. So no matter what, if you're buying in a submarket that doesn't project growth, population and jobs, it's going to be difficult. If you're not in an area that has those growth metrics, you're not going to be able to raise rents. There are even some good markets out there right now, or historically good markets out there right now, where we're showing negative growth in rental rates. Guess what that means? It means rental rates are going down. So it's a friendly way of saying declining rental rates. But this is the reality. There are some markets that just aren't going to weather well over the next 6 months, 12 months, 18 months. So it's ultra critical that we focus on those good markets.
Yeah, absolutely. Our underwriting's been very, very tight. Some of our stuff, I mean, we're not projecting that rocket rent growth, right? A lot of that stuff that we're looking at is very steady for the next couple of years. 1, 2, 3, maybe 3% growth. Sometimes flat, depending on the market. So, I mean, our underwriting has to be very, very in tune with what's going on in the market right now. So
yeah, more so than ever. I can tell you in the short strokes, what do we like? I mean, the easy ones are, there's a lot in Florida. We like Jacksonville, Florida. We like Orlando. Orlando, obviously, we have a project there that we're buying. Everybody knows about that one. But Orlando has typically been in the top 3 markets for growth and growth expectations. No matter what report that we're looking at, it's always up there. We still like Dallas. We like Arizona, but Phoenix has had its ups and downs. So in Arizona specifically, Tucson is amazing. So the top end numbers don't look as strong as maybe Phoenix, but the growth projections are all there. So we're being very critical. And in today's market, if we're not being critical, I think we're losing the race. So part of that, and I know I keep saying this, but it's all about being slow and pragmatic and being smart about what it is that you jump into. In today's market, jumping into a project simply because you want to buy something is not necessarily the smartest move. You have to be very slow and pragmatic and ultimately conservative about the numbers that you've underwritten. If you do all that, like you said, opportunity's there.
Yep.
Yeah. So that's what we're looking for. Now, I do want to add one other little piece in there. Everybody knows we're also buying hotels, right? This is a big piece of our business these days. What we put on here was about multifamily. So hotels are a little bit different. Hotels tend to be smaller. The individual assets that we're buying, we're not putting $10 million into an individual hotel. Typically, those are going to be checks of 4 to 5 to 6 million, not 10 million. The hotel assets that we focus in on typically are 100 to 120 rooms. They're usually just outside of the major MSAs. So most of the stuff that we've been buying or that we have in our pipeline right now are throughout the Midwest. The good news about the hotels that we've been buying, if we buy them correctly, is that the real expected cash on cash is anywhere between 10 and 12%. Well, let's say 9 and 12%, but it's much higher than multifamily in the short term. So it's a slightly different acquisition. It's also a different risk level. You're dealing with daily and weekly rentals versus what you would get in multifamily, where somebody signs on for a year at a time. But credit's not an issue with hotels. So it's just a different animal. But there's a place for both. And we're very focused on those 2 asset types, both hotels and multifamily. Okay, let's move on to the next.
Yep. So this is probably my favorite part. How do we look at debt financing moving forward? So what are we looking? So we're talking about what type of deals are we looking at? What type of opportunities? Multifamily, still a hot product. We're also talking about hotels. How do we look at those hotels, right? Are we looking at it with short-term debt? Are we looking at them with fixed debt or loan assumptions? What are we looking for?
Yeah, I think one of the critical pieces is this whole idea of fixed versus floating. Everybody sees the news, right? I'm sure everybody on here has read articles in the New York Times, the Wall Street Journal, and looked at everything online on the Google machine. I mean, it's all out there. Floating rate debt has been a difficult situation for a lot of investment groups. A lot of groups they bought floating rate debt with interest only periods. Why? Because everybody makes a ton of money off of that. I mean, it made complete sense as long as the rates didn't escalate too far. And what the Fed did this past year, well, it took it to that extreme. So most groups have had to then buy caps on their interest rate growth. Those are expensive. A lot of these caps, we've even had to buy a few of them. The caps can be 300,000. They could be $1 million, $1.5 million, depends on the size of the loan. But these caps were critical. And unfortunately, there are some investment groups out there that have really been hit by escalating rates based on floating basis, and they just can't get out from underneath it. And it's been very difficult for them. So what we're looking for at this point, if we're putting new debt on something, it's always fixed, and we're only looking for fixed. Now, that creates its own issue. Fixed rate debt is not coming in at 3%, not coming in at 4%. Typically, the numbers that we're seeing are between 6 and 7. In some cases, it can be above 7. So what does that mean when we're acquiring? It means that we have to be ultra critical on what the purchase price is. A 7% fixed rate, just because it's fixed, doesn't mean that all of a sudden it's a golden project. If you're not purchasing at the right number, you're still not going to make your cash flow, even though it's fixed. So we're looking for fixed rate debt, but it's still not easy. And the market's not, let's say it's not improving anytime in the short term. Based on a lot of the analyst reports that we're seeing on interest rates, we're expecting that interest rates are going to come back over the next 18 to 24 months, that they're going to come down. But are they going to come down to 3.5%? Probably not. I don't think any of us are anticipating that. But are they going to come back in the mid fives? We all hope so. I'd like to see them in the low fives, but
Yep.
I think there are a lot of much stronger and larger groups that all have their own crystal balls. They've all got their version of what reality is going to look like over the next 12 to 24 months. And let me tell you, across the board, even these multi-billion-dollar organizations, their crystal balls weren't any better than ours over the past year. So we're all guessing a little bit. We're all hoping a little bit. But the general thought is that interest rates will come down over the next couple of years.
Yep. Awesome.
So let's talk about two other pieces. One, loan assumptions. We have been looking at a number of alternatives out in the market, or a number of projects that all have loan assumptions. Now, this is not an easy process. We've got a couple of ongoing projects now where they're great projects and hugely profitable, but part of the deal was to assume debt financing that was already in place. Why would we do that? Well, often we're able to get debt that just isn't available on the open market now. So we can get, we've got a hotel project where we're getting rates that are sub 4%. We've got a multifamily project that are rates of sub 4%, and it's fixed for long periods of time. But it requires that we go through a loan assumption process.
Mm-hmm.
That process doesn't take 15 days. It can take 2 months. It can take 6 months, but it's well worth it. It's well worth the wait to get it all in place. So we're looking at those opportunities, and they exist. They're just not on every deal. Not every loan is assumable. They are not all assumable. Many of them have a due on sale clause. The second that you transition anything within that deal, it's got to be paid off. So it's not always a possibility.
Yeah, no, that's a great point. You talked about the loan assumptions. We did a loan assumption last year on a pair of hotels, and it was a little bit longer. I want to say it was 4 or 5 months that it took to get across the threshold. And once we did, I'm telling you, every investor that I talk about that fund, and they just get a smile on their face because it is overperformed well beyond anybody's wildest dreams.
Yeah.
So
Yeah.
when we were doing a loan assumption, like we're in a current loan assumption at the moment, just know that it's a journey, but it is worth it to get that
Yeah.
next step.
Yeah, we all have to be patient in this process. And the part of it is the banks themselves, the lenders themselves. They've got multiple layers, multiple servicing organizations within their systems. And if it's CMBS debt, if anybody's familiar with CMBS debt, there's even more layers. There's special servicers involved. There's a million different organizations, and you just have to work through the process. The good news is there is a defined process in going through a loan assumption. So you will ultimately get to the end of the road, and it will be a positive situation, but you have to be patient. And the expectations of, well, I put something under contract and 90 days later, you're going to have it closed and all the money's flowing. It may be a little bit longer than that, but it's well worth it.
Yep.
So the last piece that we want to talk about today with what we're looking for on new deals, especially, is the loan maturities. So everybody's probably read these articles about somebody who signed up for a 12 or 24-month loan. And initially, when times are good and money's easy to find, especially in the debt markets, maybe a 24-month loan made sense. You do 2 years plus 2 one-year extensions. Maybe that makes sense. In today's reality, that's difficult. That puts you in a position where you're forced to renegotiate every year. And when rates are going up, you do not want to be in that position. So everything that we're looking at typically has longer terms. We're even considering terms that are well beyond 5 years. So in the world of commercial loans, doing a 25 or 30-year loan, that's not real. That doesn't typically happen. We happen to be assuming a loan that was originally 40 years on a multifamily project in Orlando, but that is an anomaly. That is not normal. What's normal is commercial loans are typically 5 to 7 years, sometimes 10, but 5 to 7 years is very, very normal. What we do not want to put ourselves in the position for with any new acquisition is to have to renegotiate during the hold period. We just do not know what's going to happen in the interest markets over the next 24, 36 months. So we don't want to be in that position to have to renegotiate something. So we're typically looking for at least 5, if not 7 years.
Yep. Awesome.
Yeah.
So let's see. How we're looking at debt. And then the last one is going to be, what if this is not possible? Jason, this is a good question. Right? So we're looking for unicorns, right? We're looking for something special. We're looking for loan assumptions. We're looking for 3.8% fixed financing, and we're looking for some amazing deals. No rehab. what happens if we can't find the unicorn? What's next?
Yeah. Well, the easy answer is we could just sit on our thumbs
Mhm.
and everybody could just sit still. And like I said, the joke that I made, we could all just sit in our houses and watch Netflix for the next 6 months or 12 months and wait for things to come back. The truth is that there's an opportunity out there. Now, that doesn't mean that the opportunity is just to put yourself out there and write checks for $5 and $10 million every other day and just move forward and shut your eyes to the realities of where the market is going. It just means that we have to be ultra critical. But what could we do that's maybe a little bit different? So one thing that we've been considering and looking at opportunities, and simply because it keeps popping up, is the idea of opportunity capital. There are great performing assets that are out in the market. These are multifamily hotel assets that we know. We know how to manage these. We're an owner operator of multifamily assets and hotel assets already. So this is a skill set that we have. We have the asset management. We've got the property management side of it. We understand how to create efficient operations and really make sure that a property sings. So there are performing assets that are in some of the key markets that we really love, that are with owner operators that we really like, that we'd love to partner with. But because of whatever is happening in the market or based on how they initially acquired their project, they need help. So there are a number of projects where maybe interest rates have creeped on them. There's a need to refinance, or there's a need to change the capital stack in some way. But the truth remains that what they need is an infusion of cash. They need somebody to help them come in and let's say restack the ownership structure within these performing assets. And again, these are not broken assets. These are assets that are in great shape. Many of them are Class A in the best markets across the country, with great occupancy and great rental rates. But because of the financing structure, there's something that needs to be changed.
Yep.
So there's a need for capital infusion. And if there's a potential to put ourselves in the position to take a primary role, maybe way up in the stack, in the capital stack, and take above market returns and help solidify an asset and help solidify returns for the current limited partners in those projects, we're going to take a look at that. So that's maybe the path going forward. There are some opportunities that have already fallen in front of us at Goodegg that we're considering. And as long as they meet the expectations that we've got for our own acquisitions, this may be an opportunity out in the market. It's definitely an opportunity that some of the largest funds in the country are doing already. Yep. Everybody's heard these terms, rescue funds and everything else like that. We're not looking for distressed debt. We're not looking for truly distressed situations. We don't want to buy a C-class property just outside of Louisville, Kentucky. We're looking for good, strong performing assets that would meet the parameters that we would typically be looking for. So this is a strategy that we're considering. We're having a lot of conversations with a lot of our current investors to make sure that we do things that match with what their desires and expectations are, but that may be another path. We have our current fund that we're doing today for multifamily. We are opening up a hotel fund, and we're looking at strategically placing some of our capital in performing assets across the country with other owner operators that just need our help. Yep. So that's what this looks like going forward.
Awesome. I'm excited to share that. Like you said, I mean, we would be coming in and either helping others, like Jason and I've had multiple conversations with either other people who's just need an insert of extra cash, or maybe they're trying to put a deal together at the last second and they need cash. But I mean, there's opportunity, and like Jason talked about, this whole thing with interest rates changing, opportunities arise and they end up on our doorstep, and it's just a matter of finding out which ones make the best sense for us and our investors.
Yeah, we want to be careful and respectful with other owner operators, because we're not in the business of simply taking advantage of our position and then hurting other people. So we want everybody to win at the end of the day. There are other investment groups and other limited partners that are in deals that we currently have nothing to do with that can benefit from our strong capital position. So if there's a way to create this as a win-win, we're looking. But again, if you go back to the questions that we already put out there, all those parameters that we look for in our own acquisitions, they have to be met in any project that we're going to look at, even if we only insert capital. So if we're not meeting those parameters, then we're not going to do them. the same thing's going to apply. If the deal isn't there, if it doesn't pencil out, we're not going to stretch and take a big gamble at this point in the market. We just can't. It doesn't make any sense. All right. Well, that was the crux of our conversation. So I didn't see any questions pop up today. This is rare from this group. Typically, we get lots of questions from everybody. I love seeing all the interaction from folks just saying, "Hey, you're here, so thank you for doing that." We love having you here and just listening to us gab back and forth. But if there are any questions, now's the time. Please pop in. But if not, Max, why don't you talk about briefly Wealth Fund 2, what we're doing there, and
Absolutely.
Bring it to a close.
The fun part that I like to talk about is I talked about this on Goodegg Popovers yesterday. The more that we kind of talk about this financing structure and what we're looking for, this really kind of plays into exactly our Orlando property, right? It's fixed financing. We don't have to worry about going out and finding new debt that doesn't make sense. We're not just slamming a deal together to put a deal together, right? This thing is over 95, 96% occupied. It's cash flowing day one. It is a safe asset. No heavy rehab, built in 2021, buying straight from the developer. That's what we have on the market right now. We are, collecting funds at the moment as we speak, and we're moving right along with the assumption process of that loan. So very excited about this one. I love talking to people about that and moving forward into that. Very, very simple process. Generally, if you have any questions, you reach out to, I put my email in here already. Reach out to me or Jason in email. We'll give you a quick call, but a very simple process. You make a commitment, you verify your accreditation, and then fund. You fill out a PPM and then you fund. Very, very simple process.
Yeah, and by the way, if you do want more info on that, the place to go is straight to our website, just /fund2, the number 2. You can get more info on that, and then you can schedule a call with either one of us.
Yep. Got a question. Any update in the Terre Haute deal? Hope it's okay to ask in this forum. Absolutely. Millie, that's something we can reach out to you shortly after this Goodegg Live, but we've got very good news for you. So
yeah. So that's our process. That's the only fund that we currently have open. We are about to kick off our next hotel fund, which we're pretty excited about. And then go to the next page. Yeah. So getting in touch with us, I say this every single time. Email us first. Investor relations at goodegginvestments.com. I can say without a doubt we respond directly. Both Max and myself, we respond to that email address, and please reach out to us. And if you want to talk to us live, you can call our 888 number. It's 888-830-1450. They will either track us down individually, or they'll put a time directly on our calendar and we'll schedule a call. But either way, please reach out to us. We personally respond.
Yep.
So with that, I'm going to call it into today's Goodegg Live session. This has been great. Thanks for the back and forth, Max. And unless there are any other questions, we'll see you in 2 weeks. We'll have another good topic and we'll go from there. But it's a pleasure to see everybody. So thank you.
Awesome. Have a good rest of the week.
Bye, everyone.